The $10,000 bank rule is quietly freezing senior retirement accounts across this country, and the bank is legally forbidden from telling you it happened to yours. If you have ever deposited $10,000 or more in cash at any bank branch in the United States, a currency transaction report with your name, your account number, and the exact amount moved is sitting in a federal database in Vienna, Virginia right now. But that is only the first of 5 rules quietly freezing senior accounts in this country. And the most dangerous one does not require $10,000 at all. It requires just over $5,000, and something the bank alone decides is suspicious. Stay with me to the end of this video, because the rule that caught 74-year-old Harold from Ohio is the one nobody sees coming, and the action step to avoid it takes less than 20 minutes. The rule at the center of this is called the Bank Secrecy Act. Congress passed it in 1970, and the $10,000 threshold has not moved in 56 years. Think about that for a second. A loaf of bread in 1970 cost 25 cents. Today costs over $4. A new Ford pickup truck in 1970 cost $2,700. Today costs over $50,000. But the cash amount that triggers a federal report on your bank account has never been adjusted for inflation. Not once. In 1970, $10,000 was a down payment on a house. Today, it is barely a used car. Every year that threshold has stayed frozen means more ordinary retirees on ordinary days get pulled into a reporting system that was originally designed for drug cartels and money launderers in the Nixon administration. Here's the first rule. When you deposit or withdraw $10,000 or more in physical cash in any single day across all your accounts at that bank, the bank is required by federal law to file a currency transaction report with the Financial Crimes Enforcement Network. They file it on FinCEN Form 112. The report includes your full legal name, your social security number, your date of birth, your account number, the exact amount, and the source of the funds if you volunteered one. The bank does not need to tell you they filed it, and in most cases, they do not. The report goes into a database that every federal law enforcement agency can search. The Internal Revenue Service can cross-reference it against your tax return. The Drug Enforcement Administration can query it as part of any investigation. The Federal Bureau of Investigation can use it to build a profile on you before any crime has been suspected. What most seniors do not know is that this rule applies to withdrawals, not just deposits. If you walk into your bank branch and withdraw $12,000 in cash to buy a used recreational vehicle from a private seller, that triggers a currency transaction report on you, not on the seller. If your husband passes away and you need to close out a safe deposit box and the cash inside comes to $15,000, a currency transaction report is filed. If you cash a single paper treasury bond at maturity for $11,000, a currency transaction report is filed. The rule does not care why you are moving the money. It only cares about the dollar amount. But this is where the trap gets worse. Therefore, you need to understand the second rule before you ever walk into a branch again. The second rule is called structuring, and it is a federal felony that you can commit by accident. Structuring is defined in Title 31 of the United States Code, Section 5324. The statute says it is a crime to knowingly structure transactions for the purpose of evading the currency transaction report. The penalty is up to 5 years in federal prison, a $250,000 fine, and civil forfeiture of the funds involved. And here's the part that shocks every retiree who learns about this for the first time. You do not need to be hiding criminal money to be charged with structuring. You only need to have split a deposit into 2 or more smaller transactions for the purpose of keeping any single one under $10,000. A restaurant owner in Iowa named Carol Hinders ran her Mexican restaurant for nearly 40 years. She deposited her daily cash receipts always under $10,000, because that was what her daily receipts were. The Internal Revenue Service seized her entire bank account, $33,000, without ever filing criminal charges against her. She had to hire an attorney and fight for 18 months to get her own money back. A convenience store owner in North Carolina named Lyndon McClellan had $107,000 taken from his business account for the same reason. The seizure happened before any investigation, before any hearing, before any judge heard his name. The federal government can take your money first and argue about it later. And they have done it to hundreds of ordinary business owners and retirees who simply deposited cash the way they always had. And Carol and Lyndon are not the only ones. Randy Sowers ran a dairy farm in Maryland called South Mountain Creamery for over 30 years. He deposited his farm stand cash receipts in amounts that were usually under $10,000 because that was what the farm stand took in on a weekend. The Internal Revenue Service seized $63,000 from his operating account. He was not charged with any crime. He had to settle for the return of most of his money after a 2-year legal fight and significant media attention through the Institute for Justice. The pattern in all three of these cases is the same. An ordinary small business owner, depositing cash the way their business naturally generates it, wakes up one day to find the federal government has taken their money first and is asking them to prove their innocence afterward. What the compliance software looks for is not a single large deposit. It is a pattern of transactions that cluster just below the reporting threshold. Bankers and federal investigators call these structuring indicators. A series of deposits of $9,500, $9,200, and $9,400 over 2 weeks will flag more aggressively than a single deposit of $30,000 because the pattern suggests an intent to evade the reporting threshold. This matters for retirees in a very specific way. If you sell a car, sell a boat, sell a piece of land for cash, and you instinctively stagger the deposits because you think that is the more responsible thing to do, you are doing the exact thing the algorithm is trained to flag. The bank does not know your intent. The algorithm does not know your intent. It reports the pattern and lets the Internal Revenue Service decide what to do with it. For retirees, the structuring trap looks like this. You sell an old motorcycle in your garage for $18,000 cash. You know that depositing $18,000 in one day will trigger a report. So you deposit $9,000 on Monday and $9,000 on Friday because you think that is the safer option. You are now in violation of federal law. It does not matter that the money is yours. It does not matter that you paid every tax you owed. The act of splitting the deposit to avoid the report is the crime. Therefore, the safer move is the opposite of what most people would assume. If you are moving more than $10,000 in cash, deposit the full amount at once. Answer the banker's questions about the source, and let the report be filed. A currency transaction report on a legitimate source creates a paper trail that protects you. A structuring charge on the same money can cost you the money and 5 years of your life. Now we come to the third rule. And this is the one that caught Harold from Ohio. It is called the Suspicious Activity Report. And unlike the Currency Transaction Report, it has no fixed dollar threshold. It has no trigger amount you can plan around. It fires when the bank alone decides your transaction is suspicious. Banks file over 4 million suspicious activity reports every year to the Financial Crimes Enforcement Network. Every major bank in the country has an internal compliance department whose only job is to scan your transactions for patterns the software flags as unusual. If you typically deposit $2,000 a month from a pension check, and one day you deposit $6,000, the software may flag it. If you normally wire money to the same two accounts, and one day you wire $5,000 to a new account, the software may flag it. If you start withdrawing larger than usual amounts in the weeks before a grandchild's wedding, the software may flag it. When it does, the bank files a suspicious activity report, and they are legally prohibited from telling you they did it. That prohibition is called suspicious activity report secrecy, and a banker can lose their job and face personal fines for disclosing a filing to the customer it concerns. Harold was 74 years old. He had been with the same community bank for 31 years. In February, his wife of 52 years passed away. The life insurance paid out $85,000. Harold deposited the check, and because the bank had never seen a deposit that size on his account, their compliance software flagged it. A suspicious activity report was filed. Harold did not know. 2 weeks later, Harold tried to transfer $15,000 to his daughter to help with his granddaughter's college tuition. The transfer was blocked. His account was frozen. The bank manager could not tell him why. When he called the compliance hotline, the representative said only that there was a hold on the account, and they could not provide further details. Harold's account stayed frozen for 93 days. During that time, 2 of his automatic bill payments bounced. His Medicare supplement coverage lapsed for 19 days, and his daughter had to move money from her own savings to cover the tuition deposit. When the hold finally cleared, no one apologized, no one explained. The bank simply told Harold his account was reactivated. Harold is not alone. Margaret was 69 years old when her husband of 44 years died of a sudden heart attack in March of last year. Within 60 days, she received a life insurance payout of $120,000. A rollover distribution from her husband's individual retirement account for $210,000, and the proceeds from selling their second home in Florida for $385,000. Every one of those deposits was legitimate. Every one of them was legally hers. But because 3 deposits of that size hit a retiree account that had previously averaged $4,000 a month in activity, the compliance software generated not 1, but 3 separate suspicious activity reports on her account in under 8 weeks. Her checks stopped clearing. Her debit card was declined at the grocery store. She was told nothing about why. It took her attorney 4 months and a formal regulatory complaint to get the freezes lifted. In the meantime, she paid late fees on her property taxes, missed a refill on a prescription heart medication, and had to borrow against her daughter's credit card to bury her husband. What a freeze actually does to your daily life is often worse than the hold itself. A compliance hold typically blocks outgoing transactions first. Your automatic mortgage payment fails. Your property tax withdrawal bounces. Your Medicare supplement premium auto deduction is rejected. And because most policies have a 30-day grace period, if the freeze lasts longer than that, the policy cancels entirely. Your life insurance premium, your long-term care insurance premium, and your auto insurance premium may all cascade into non-payment. The bank will not intervene to stop these cascading failures. Compliance departments operate on a separate track from customer service, and customer service cannot access compliance records. You are essentially locked out of your own financial identity while the bank's internal process runs, and the only people who can speed it up are bank compliance officers, who by policy do not take phone calls from customers. Most seniors think they will never face this, because they have nothing to hide. But this is a misunderstanding of how the system works. The suspicious activity report does not require evidence of a crime. It requires only that the bank's software or compliance officer consider the transaction unusual. Grief payouts, inheritance checks, home sale proceeds, Medicaid spend-down withdrawals, annuity surrenders, reverse mortgage advances, and retirement account rollovers are all triggers that show up regularly in suspicious activity report filings. None of these are crimes. All of them can freeze your account for 90 days or longer while the compliance review runs. But there is a fourth rule, and this one specifically targets retirement accounts, which is why nearly every senior watching this is exposed. The fourth rule concerns how banks treat retirement account distributions, and it depends on the form those distributions take. A direct rollover from one retirement account to another, handled through a trustee-to-trustee transfer, is generally not reportable because no money touches your personal account. But the moment a distribution check is cut to you personally, even if you plan to redeposit it into an individual retirement account within the 60-day rollover window, the bank sees an incoming deposit that does not fit your normal pattern. If the amount exceeds a threshold the bank's software considers unusual, a suspicious activity report can be filed on the incoming funds. If you then move those funds out quickly to complete the rollover, a second report can be filed on the outgoing side. You can trigger 2 reports on the same dollar, and you never know what happened. Required minimum distributions from traditional retirement accounts are another trigger. If you are 73 years old or older, and your required minimum distribution this year is $42,000, and you take it as a single annual payment, the incoming deposit may be flagged. If you then use that money to pay a large medical bill or fund a home repair, the outgoing transaction may be flagged separately. The bank is not trying to hurt you. The compliance software is running a pattern match on anomalies, and your retirement account distribution looks like an anomaly because it is not a recurring pattern the software has previously indexed. The dollar thresholds the compliance software uses internally are not public, but consistent patterns appear across the industry. Wire transfers over $3,000 to a recipient not previously in your account history are reviewed. Cash transactions over $5,000 in a single day, even if under the $10,000 currency transaction report threshold, are reviewed manually by a compliance officer. Incoming deposits from sources the bank has not seen before, over a threshold the bank sets based on your account history, are reviewed. And here is the compounding effect. A transaction that crosses 2 of these thresholds at once, for example, a wire transfer of $6,000 to a new recipient, is more likely to escalate from an internal review to a suspicious activity report filing than a transaction that crosses only 1. For a senior who has had the same checking account for 20 years and who suddenly needs to move money for medical care, a home repair, or a family emergency, the internal review thresholds are particularly harsh. The account history the software compares your new activity against is the same account history it built during your working years and your early retirement. Your life circumstances have changed. The software has not. A single major medical event, a single large inheritance, a single rollover from a 401k to an individual retirement account can push you into pattern territory the algorithm reads as risk, not simply as life. And every time one of these transactions runs through your account, whether it is flagged or not, the metadata is recorded and added to your personal bank profile for future comparison. For widows and widowers, the exposure is much greater. Spousal inherited retirement accounts, annuity beneficiary payouts, life insurance proceeds, pension survivor benefits, and joint account reassignments all appear during the same grief window. Banks call this the fraud triangle because people in the grief window are statistically more vulnerable to scams. The software is tuned to flag anomalies during that window for the widow's own protection, but the practical effect is that more senior accounts get frozen in the 3 months following a spouse's death than at any other point in life. Therefore, the protection move for retirement account holders is to plan the transaction before it happens. If you know a large distribution is coming, walk into the branch before the money arrives. Speak to a personal banker and tell them what you are about to do. They cannot stop the compliance software, but a documented conversation in your file gives the compliance officer a reason to clear the transaction quickly when it triggers. What takes 90 days without that conversation can take 3 days with it. The fifth rule is the newest one, and it concerns something called beneficial ownership reporting. Until earlier this year, the Corporate Transparency Act required every small business owner, every trust with a business account, and every limited liability company to report their beneficial owners directly to the Financial Crimes Enforcement Network. For seniors with family limited liability companies, rental property holding companies, small farms organized as limited liability entities, or living trusts that own a business account, that meant filing a new federal report with personal information on every owner and every family member with a stake. A federal court struck down the Corporate Transparency Act as applied to domestic filers in early 2026. The federal reporting requirement was paused, but state legislatures have started filling the gap. New York passed the Limited Liability Company Transparency Act, which requires beneficial ownership reports directly to the state. Other states, including California, Massachusetts, Pennsylvania, and Illinois, have introduced or passed similar legislation. The practical effect is that many senior business owners who thought they were free of federal reporting are now facing the same requirement at the state level, with different deadlines, different penalties, and different access to the information by law enforcement and private parties. The New York Limited Liability Company Transparency Act took effect on January 1st of this year. Every limited liability company formed in or doing business in New York must file a beneficial ownership disclosure or claim a specific exemption. The initial penalty for failure to file is $250, but the penalty for knowingly filing false information or for failing to update a filing when the ownership changes can reach $10,000. California's proposed companion bill would apply similar requirements to every limited liability company registered with the California Secretary of State and would make the information publicly searchable, not just accessible to law enforcement. Massachusetts and Pennsylvania have versions at various stages of the legislative process. Illinois enacted its own version last year, with a 6-month grace period that expires this summer. For a senior who owns a simple family limited liability company, perhaps holding a cabin on a lake or a rental duplex in another state, the practical effect is that the filings multiply. One entity may need to file in 2 or 3 states, each with its own form, its own deadline, and its own penalty for a missed deadline. Most seniors have never heard the phrase beneficial ownership in their lives. Most small entity owners who set up a limited liability company 20 years ago to protect a single piece of property have no idea that a new reporting regime now governs that entity. The worst outcomes come from combining ignorance of the rule with the cascading penalty structure. A missed $250 filing can grow into a dissolved entity, a lost asset protection shield. And the personal exposure that the limited liability company was originally designed to prevent. For seniors with any of the following, the state reporting rules apply, or may soon apply. A family limited liability company holding a vacation home. A single-member limited liability company used for rental property. A living trust that holds a business interest. A farm organized as a limited liability entity. A consulting practice run as a pass-through company. The state forms can request personal information, including your home address, your date of birth, and in some cases, a government identification number. Missing the filing deadline can trigger administrative dissolution of the entity, which in turn can expose personal assets that the entity was shielding. Therefore, the fifth protection move is to identify every entity you own or control that holds a bank account or a piece of real estate and confirm its state reporting status with a licensed attorney or a certified public accountant before the end of this quarter. Now, here is the action plan. 5 steps. Each one takes less than 30 minutes. First, call your main bank branch and ask the personal banker to document your most common deposit and withdrawal patterns in your relationship file. If you know you will be selling a car, closing a safe deposit box, or receiving a large life insurance payout in the next 6 months, tell them now. The file note protects you when the compliance software flags the future transaction. Second, stop splitting deposits to stay under $10,000. If you have to move more than that in cash, move it in one transaction and let the currency transaction report be filed on a clean source. A structuring charge can cost you the money and your freedom. A currency transaction report costs you nothing. Third, if you expect a retirement account distribution, a rollover, a required minimum distribution, or an inheritance payout. Call the bank before the money arrives. Schedule a 5-minute appointment with the branch manager. Put the expected amount, the source, and the intended use in the notes of your account. It will not prevent a flag, but it will cut the freeze time from 90 days down to 3. Fourth, if your account ever freezes without explanation, do not argue with the teller. Ask for a written statement of the hold and the contact information for the compliance department. File a complaint with the Consumer Financial Protection Bureau the same day. A complaint creates a paper trail and forces the bank to respond on a federal timeline. In most cases, the hold lifts within 10 business days after a Consumer Financial Protection Bureau complaint is filed, even if the underlying suspicious activity report review is still open. Fifth, if you own any entity that holds a bank account, a rental property, or a family business interest, pay a licensed attorney or a certified public accountant in your state to review your beneficial ownership reporting status before the end of this quarter. The federal requirement is paused. The state requirements are accelerating. Miss that filing, and the entity dissolves, and every asset it was protecting walks back into your personal name.